Hey there, I welcome you to the fourth chapter of our discourse on option trading strategies. In the previous three chapters, we have learned about strategies which work in a market when you're expecting moderately bullish view in the market. Now, in this chapter and the next chapter, we'll talk about two option trading strategies which work when you have a moderately bearish view on the market. When I say moderately, I've already explained that you're expecting small amount of weakness or small volume of weakness, but not a major move on the downside. If you're expecting major move, there are other strategies which could be used, but you're expecting moderate weakness, then you could use this strategy. Now, when is it that you expect moderate weakness? It is when you have a current moment which is slightly strong or a strong momentum, but you're expecting a small amount of dip or correction. So to play that kind of weakness in the market, you could use this strategy. And the strategy which I'm talking about is called as the bear put spread. Now, when you say the word spread, and the strategy of bear put has two legs, and you are taking put option position as the name says, and you're expecting bearish momentum on the downside. Now, what are the advantages of taking this strategy? For starters, even if your views go wrong and the market goes up, your loss is capped. That is, you can't lose beyond a certain point. And if the market exaggerates on the downside also, you can't make more money beyond a certain limit. That is, your both loss and the profit are capped in the strategy of bear put spread. Now let us understand what are the legs which we use while we are implementing the strategy of bear put spread. So under this strategy of bear put, for starters, you buy one at the money put option. Remember, you buy one at the money put option and you sell or write one out of money put option. So you have both buy position and sell position running when you are implementing the strategy of bear put spread, and which is why even your profit is capped and your loss is also capped because you have both buy and sell position in the market. Now let us understand the payoff of this strategy on the chart, and let us see how does the profit and loss change as and when the market moves. Now again, you go to the strategy builder which you use and you take the option of bearish here and you apply the strategy of bear put spread. Now they already pre-chosen legs which you could use, or I actually want to go slightly more out of money when I'm writing. So I'm going 19,700 and I chose the next expiry because today is the expiry and I don't want to, the premiums will be lower. And you execute the strategy on the chart. Now, as you can see, your profit and loss are capped. That's the first thing which I saw when I see the strategy payoff chart. Even your loss is capped if the market goes up, and your profit is capped when the market goes up. And which is why scalability becomes a big advantage when you're using the strategy of bear put spread, because you know how much you're going to lose or how much you're going to make, so you can go multiple lots in this. So that is one advantage of strategy of bear put spread. Now let us understand what are the points of break even in this strategy. Now, as you remember, I have bought at the money and sold out of money, which means I have to pay more premium than what I receive. So how do you reach the point of break even? So what you do, you take at the money strike price, which in our case was 19,800. As you see from the execution of the strategy, 19,800 is the strike price which we have bought, and you sold 19,700 put option, and the difference between the premium paid and received was about 44 units. So 19,800 minus 44 units becomes a break-even point, and which you can see here, 19,756 is your point of break-even. This is the point below which if the market falls, you will make money in this strategy. So that is how the implementation of strategy of bear put works for you. Now coming to the part of margin. Now normally what traders feel that when you have sold something, you have to pay a higher margin. But remember, in the previous chapter we discovered a hack. If you buy a leg first and then you sell another leg, the margin reduces considerably. So here in this case also, it shows a margin of about 20,000, which can be slightly up and down depending on how the market or how the volatility is. But if you were just writing an option, this margin would run at least 1.2, 1.3 lakhs. So that is one hack which is used by a lot of traders to be able to reduce the margin in the market. But the important thing is this: when you're exiting this strategy, always exit your sell leg first, because if you exit the buy leg first, you'll get a margin call from a broker, so you'll get emails or calls from them. So when you're exiting the strategy, either exit both the legs simultaneously, or if you're exiting part by part, execute your sell leg first and then exit your buy leg first. So that is a simple strategy of bear put spread. So what we learn from this strategy, you use this strategy when you have a moderately bearish views. When it's moderately, talking about 0.5% to 1% move. If you're expecting bigger moves or exaggerated moves, you have better strategies which could be used and that have better chance of giving you higher profits. So that is it from in this chapter. So in the next chapter, we'll discuss another strategy which can be used when you have moderately bearish view. And the difference is that in that strategy, you have info initially and less outflow. So we'll discuss that strategy in next chapter. So see you there.